Hello, this is David Hoxworth, the insurance coach, and today I wanted to shoot a video explaining what a deductible and coinsurance is on a health insurance plan. So this is a health insurance video, an educational video. I wanted to let you know what a deductible is and what coinsurance is on health plans, and also in addition to that, kind of a bonus is I wanted to explain how the total protection plan, which I'll get to at the end of the video, how that supplements and interacts with the health insurance plan. So what I have here, I'm going to have a series of illustrations. Just going to try to, it helps to have these things kind of in a chart form to see what I'm talking about. But before I get to the chart, I wanted to talk about just kind of the basic idea, the structure of a health plan. There's, and I'll get to how these are defined in a minute, but there's the deductible and then the coinsurance, and they're kind of together. They're basically tied together in a health plan, and basically the first thing you need to know about the deductible and the coinsurance with a health plan is what applies to them, okay? Because different health plans have different healthcare services that apply to the deductible and the coinsurance, okay? So, for example, the most common type of health plan out there is a copay plan, all right? And on a copay plan, the copays apply to minor services. Things like doctor's visits and urgent care and prescriptions, for example. Those are what the copays apply to. And on copay plans, those minor services that have copays associated with them do not apply to the deductible and coinsurance. They're actually outside of the deductible and coinsurance structure. Okay. Now, in those cases of the copay plan, the services that do apply to the deductible and the coinsurance are major services, things like hospitalizations and surgeries and major diagnostic exams like CAT scans and MRIs, as well as emergency room. Those are kind of the biggies. Okay, so these are the major services, more expensive services. That's where your deductible and coinsurance come into play. Those are the services that apply to a deductible and coinsurance on a copay plan. Now, on the other hand, other types of health plans out there are structured differently. For example, what are typically called traditional health plans, and also HSA plans, health savings account plans. Their structure is that every service, every kind of healthcare service, whether it's major or minor, applies to your deductible and your coinsurance. So whether it's a doctor's visit, whether it's a prescription, typically, also the major services like hospitalizations and surgeries and so forth, all of those, the cost, you're going to pay the full cost for that service, and all of it is going to apply to your deductible and then your coinsurance. Okay. So that's kind of the two big categories. Your copay plans, where they're sort of separated, the services are separated. Some apply to the deductible and coinsurance, some don't. And then your other type of plans, your traditional and your HSAs, where all services apply to that. Okay, so that's kind of the general layout of the health plans. I wanted to get that across before I really got into this. So first of all, to explain, diving right in here, just your deductible and your coinsurance. Okay, I'm going to start with the deductible because that's really where the health plan starts. Okay, so whatever services apply to the deductible, whatever they are on the health plan, that's what you need to find out first. Okay, but your deductible is the amount of money that you, as the consumer, are agreeing with the insurance company to pay out of pocket from the first dollar before the insurance carrier is going to pick up any of the costs. And again, this is only on services that apply to your deductible and coinsurance. Okay, so on a copay plan, this doesn't apply to doctor's visits, urgent care, prescriptions, for example. Okay, so in this particular illustration, this is just a really simple generic, I wanted to keep it simple here. Health Plan 1, Health Plan 2. Both are $1,000 deductibles. Okay, this is considered a low deductible plan. Okay, so that's you're saying I'm going to agree to pay the first $1,000. After the $1,000 is satisfied, then we get to the coinsurance. Now let me point out that statistically in the United States, okay, right now we're in May of 2013. Okay, statistically in the United States, it's very rare actually for people to satisfy this whole deductible, even at $1,000 in any given year. This is, by the way, per calendar year, $1,000 per calendar year. Okay, so somewhere between 80 and 90% of consumers do not satisfy their deductible even at this low level of $1,000. Okay, so let's say you take a 10-year period of time, if you're an average person, especially if you're a healthy person, even more so, you are only going to actually use this whole $1,000. You're actually only going to have services, healthcare services that, actually amount to your deductible amount once every, 10 years, maybe once every 8 years, something like that. So it's not a very frequent. So, somewhere between 80 and 90% do not hit it on, in any given calendar year. Okay, so it's pretty rare. 10 to 20% of the time you might actually hit your deductible. Okay, if that makes any sense. Okay, so but anyway, once you do satisfy the deductible, $1,000 in this case, then that's when you get into the realm of coinsurance. Okay, coinsurance, the reason it's called that, the co refers to you are sharing. Okay, you and the insurance company are sharing the costs together after the deductible. Your cost first, totally yours right here with the deductible. Then you are sharing with the insurance company, and it's expressed as a split, a percentage split. In this particular illustration, I put the two most common that you see on the market. Okay, 80-20. The first number is always the insurance company's responsibility, 80%. So the insurance company is going to pay 80%. You are going to pay 20%. And this is the other most common one, 70%, 30%. There are other examples. There are 60-40s out there. There are 90-10s out there. You also even have 100 zeros out there, which is, for example, the most common version of that is HSAs. Those are usually 100 zeros. Okay, so anyway, and then they'll also say, here's the maximum that you, the consumer, will pay for coinsurance in any given year. So in this case, this is just an example. It doesn't mean that all 80-20s are 3,000, but this is just an example, kind of a common one. In this case, you put the potential maximum you could pay in any given calendar year for coinsurance. In this case, the 80-20 case, is $3,000. Okay, so your maximum out of pocket for Health Plan 1 is the $1,000 deductible plus the $3,000 coinsurance. Okay, which is equals this, the maximum total out of pocket exposure being $4,000. Again, let me point out, if this was a copay plan, the minor services, doctor's visits, urgent care, prescriptions, are outside of the deductible and coinsurance. And so this maximum total out-of-pocket exposure does not include the copays for those minor services or any potential deductible. Sometimes, very commonly nowadays, prescription plans on these copay plans have a separate deductible outside of the normal deductible. Okay. So anyway, that's how that works. The other example here is the 70-30 example. The maximum for coinsurance is $5,000 plus the $1,000 equals $6,000. Okay, so this is the most out of pocket you could have in any given year for services covered by the deductible and coinsurance. Okay, and then here's a common premium, $450 a month. This is, of course, the premium is based on your age, your tobacco status, your sex, where you live in the world, etc. So these are just generic examples. Do not take this to mean anything specific. Okay, so anyway, $450 a month, $400 a month. These are kind of these are kind of your copay plan type of premiums for this setup in general. Okay, they're obviously going to vary depending on a lot of factors. Okay, so that's kind of the illustration and kind of the explanation here of the deductible and coinsurance. Now I want to move on and kind of expand this a little bit. I'm adding in here health plan 3, health plan 4. Now our deductible, the only thing that changed here is our deductible went up to $2,500. Okay, so I just wanted to illustrate going up a little bit in your deductible. These are the same. Okay, your maximum total out-of-pocket exposure, which is the coinsurance plus the deductible, is obviously higher here than they are here. But here's what happens to your premium. Obviously, you're taking on more of the responsibility here, more out-of-pocket exposure, so now your premiums are lower. Okay, just want to point that out. I'm going to get to a point here. I'm going to make a point here in a minute. Okay, I'm going to expand it even further. Same idea. Higher deductible, now it's $5,000. More out-of-pocket exposure, lower premiums. Okay, we're starting to get down to almost half of what these premiums were up here. Okay, so you start to get these higher deductibles and higher out-of-pocket exposures, and sometimes people get scared of that, and that's reasonable. But in a minute I'll explain why this might be something that might interest you. The premium's getting lower. I'm going to show one more. Okay, getting all the way up to a $10,000 deductible and an even higher out-of-pocket exposure, okay, and an even lower premium. So now you're definitely under half what you started with up here with 1,000. Why am I pointing this out? Okay, here's the scoop. If you are a healthy person, or if you're even an average person with your health, you are not really any more likely, statistically, practically speaking, to satisfy your deductible at $1,000 and start using the insurance, okay, coinsurance and so forth, than you are at a $5,000 or a $10,000 deductible, for example. Okay, so in other words, let's say you had a $1,000 deductible versus a $10,000 deductible. Here you're paying, let's say you're doing the 80/20, you're paying $450. If you're doing a $10,000 with the 80/20, you're doing $230. Okay, so pretty much right around half the price. Okay, so you're saving $220 a month. Okay, by going up to your $10,000 deductible. 9 years out of 10 or 8 years out of 10, you're not going to use these healthcare services so that you have to hit your deductible here or here. Okay, if that makes any sense. So why not consider at least leveraging your good health and saving premium here, because practically speaking, you're not going to actually experience this deductible and coinsurance world in most given calendar years. 1 or 2 years out of a 10-year period, you may get into this. That probably statistically you will get into this one or 2 years out of every 10 years, and then you will be dealing with these higher costs. Okay, if you increase your deductible. Okay, but in most years, you'd be saving a lot of money per month, and you can imagine over a 10-year period, what kind of savings you're looking at. If you're looking at a couple $100s a month, and this is, by the way, this is like a per person amount. If you had a family, these all obviously get multiplied by, not necessarily exact multiplication, but they're, the premiums are going to be even higher, is my point, for a family. And the difference between, the high deductible and the low deductible is going to be even greater. So if you have a family, it's even more so. Okay, so my point is to consider doing a high deductible is a good strategy financially for most people. Now, if you're a chronically ill person, this is probably not a good idea. You probably do want a lower deductible because you're probably going to be utilizing the services and needing the financial protection. Okay, now let me, and by the way, one quick thing I forgot to mention earlier, once you hit this maximum amount here on the coinsurance. After that, so you've paid your whole deductible, you've met your coinsurance max. This is, if you're having a bad health year. Okay, after you hit the maximum, it's probably obvious, but after that, the insurance company pays 100%. Okay, so that's how it works. So you're paying all this, you're paying a split here, and then after the coinsurance, the insurance company is paying 100%, you're paying 0. Okay. All right, so I wanted to get to that before I moved on to this last thing. Now, the last thing I promised I would talk to you about is the total protection plan, okay? The total protection plan. And what the total protection plan is a way to supplement your health plan in order to give you increased coverage and increased financial protection from the coverage, and still saving money over a low deductible plan. Okay, so let's take a look at that structure. Okay, so we're going to look at this one first. I went back to just the 1,000 through the 5,000 deductibles here. Okay, so right here, the total protection plan, what it consists of, it's supplemental coverage in the form of accident coverage and critical illness coverage. Okay, statistically in the United States, when people are utilizing major services on a health plan, again, things like hospitalizations, surgeries, major diagnostic exams, and emergency room, it is 83% of the time it's because of either an accidental injury or a critical illness. Okay, accidental injury of any kind. Okay, injury at the home, injury at work, injury on vacation, injury during recreation, car accident, whatever. Okay, any kind of injury from an accident. Critical illness is, being diagnosed with a major life-altering illness like internal cancer, heart attack, stroke, end-stage renal failure, aka kidney failure, Alzheimer's, paralysis, blindness, things like this. Okay, so anyway, so by buying supplemental coverage, accident and critical illness, you're going to protect yourself almost all the time, 83% of the time statistically, from having the out-of-pocket exposure. Okay, and the concept here is to at least match the maximum total out-of-pocket exposure with the coverage. Okay, so in this case, this was $8,000 maximum total out-of-pocket exposure here. This one was $10,000. So I'm doing a $10,000 accident policy and a $10,000 critical illness policy. Okay, and by the way, this is per occurrence, $10,000 per occurrence, and this is $10,000 per diagnosis. Okay, all right. And these are kind of generic examples of pricing, just like the health plan premiums were. Okay, so the accident is $40 a month for $10,000. The critical illness is about $30 a month for $10,000. Again, these vary based on age, based on tobacco status for the critical illness, etc. Okay, so if you add these in, 30 plus 40 is 70. So if you're adding 70 to these numbers here, your total premium for the whole thing, health plan premium plus accident plus critical illness, your total premium, you're looking at $345, $295 in this illustration. Okay, and you can see that these numbers here are lower than these health plan premiums just by themselves. They're even lower than these. Okay, and frankly, by having total protection right here with the accident plus the critical illness plus the health plan, this scenario right here, you have better overall coverage than you do up here with a $1,000 deductible health plan by itself. Okay, and still a lower premium. So you're getting better financial coverage at a lower cost. So what the total protection plan does is it takes the scariness out of the high out-of-pocket exposure from a high deductible health plan. Okay, that's what this does. So it provides you a way of getting affordable coverage, more affordable coverage than you probably have now. Okay, and still having, frankly, increasing your coverage, having better coverage than you have now. Okay, and one last slide here. This is the same thing, but now I've added back in the $10,000 deductible health plans, which have these, $13,000 out-of-pocket exposure, potentially $15,000 maximum out-of-pocket exposure here. So now I've bumped the accident up and the critical illness up to $15,000 each. The accident doesn't go up much, $42 a month instead of only $40. Critical illness goes up about $10 here. So you're at 40 plus 42, $82 plus these premiums here. So here's your total premiums, $312, $262, less expensive than this one and way less expensive than this one. Again, superior coverage. This, even though there's a high deductible, even though there's a high out-of-pocket exposure, the overall coverage here or here is superior than this low deductible health plan by itself, and they all have lower premiums than these guys up here. Okay, so hopefully this makes sense to you. This is a strategy that I recommend to many of my clients, frankly most of my clients, because most of my clients are either at least average health, if not healthier than that. And so it's just a way to leverage your good health, to take advantage of the savings of a high deductible plan, and then still protecting yourself from your, the major financial hardship here, protecting yourself from that maximum out-of-pocket exposure by supplementing with the accident and critical illness, so that most of the time you're actually providing yourself with better coverage than you are with a low deductible health plan. Okay, this was, again, hopefully this was helpful to you to understand a health plan structure, specifically the deductible and the coinsurance and how they work, especially with the coinsurance because it's probably the least understood aspect of health plans out there in my experience, and then also how the total protection plan can supplement the health plan and help you to get better coverage at a lower cost. All right, till next time, this is David Hoxworth, the insurance coach. Thank you very much. Bye-bye.